take a look at all things money matters now. The JSE All Share index was slightly higher this morning following Friday's decline, mainly supported by tech stocks and industrials. Meanwhile, the rand is on the back foot as the dollar firmed on investor bets that the U.S. Federal Reserve would keep monetary policy tight for longer. Petri Redelinghuys is the trader and founder of Herenya Capital Advisors. He joins us now to advise us about the latest market moves. Hello, Petri. So the rand has breached the 18 rand against the dollar mark. What's driving the plunge?
Good afternoon. So, sure, I don't know. There's a lot of risk-off sentiment. There was quite a few risky things that took place over the weekend, which has kind of dulled sentiment somewhat, I think. And also particularly, we still do have this narrative of what is CPI going to do? CPI data from the US coming out later this week, which is likely to drive markets, particularly around that inflation narrative. Is CPI data starting to cool off? Does this mean we have an easier road ahead in terms of interest rate hikes? Or is CPI data still running pretty hot? And do we see increased interest rate hikes going forward? So there's a huge amount of uncertainty around that. Also, what this is essentially causing is quite a strong rally in the dollar. So we've seen the dollar index, the US dollar index, trade from around 101.30 to around 103.70 where it is now. So this means broad dollar strength versus the majority of other currencies. And this, of course, bodes ill for emerging market currencies like ourselves. So those are some of the drivers behind this. I mean, we touched just above 18 rand to the dollar earlier today. Also, we can't ignore our own local, political shenanigans, if you will. There are also obviously factors like state of emergency over electricity. I mean, we could no doubt debate that for quite some time. And I'm sure there are lots of fiery, heated opinions on both sides of the equation there. However, that is definitely not good news for, the investment outlook of South Africa. At least the one positive here is that something is going to be done, and probably the doors are going to be open for private industry to come in and take advantage. Well, not necessarily take advantage, but bring solutions. And we've seen so many times those who bring solutions are often those who are rewarded very well. So hopefully that's a bit of good news. But in the short term, it is seen as, relatively negative sentiment. We know that electricity supply is going to continue to be a problem. And we have these macro overhead risks, which are yet unknowns or, yet unaccounted for, if you will, where we have a number of different things, like, for example, a relatively strong labor market. We've seen some contraction in the tech space, but is that broader based? Is it going to be broader based? What is inflation going to do on their side? Considering that the labor market is still so strong, does that mean that, their inflation is going to run a bit hot and that interest rates are going to have to keep going up? These are the things that the market is trying to digest, and as for now, they're just taking risk off of the table. And unfortunately, emerging market currencies, emerging market investments in general are one of those riskier things if you look at the international sort of players. So they are essentially getting out of our market. We also have had a number of days last week and today so far as well, where volumes traded through the JSE is very, very low. So it shows that's indicative that international investors and international participants in the market are not really, participating so much in our market, which is probably why we're seeing the rand slide as well.
Yeah, well, to your point of electricity, not only do we have the state of emergency, disaster, I beg your pardon, but we've also got Minister of Electricity who's waiting with a cape, ready to fly on over to Eskom. And apparently, according to the ANC, he'll eat, sleep, breathe Eskom. So we'll see what happens there. Let's take a look at gold, because it's following the same theme. It's under pressure as expectations of a prolonged disinflation story are being challenged. Oil prices, on the other hand, slide on short-term demand concerns over U.S. inflation data, meaning what?
Okay, so there's a lot of different stuff happening at the same time here. And I mean, I'm glad that you bring this up because it shows you just how much confusion there really is in the market. So gold is coming down on the basis that, well, inflation might not necessarily be that high. And we might actually be in a good economic, spot, and we continue to see economic growth. And if inflation starts to cool down, we'll see interest rates start to cool down, we'll see equities start to run. So why do I need to hold a safe haven asset, right? To protect myself from potential recession or devaluation of equities, when we have all these signs that we might have potentially seen peak inflation and that things are going to get better from here. So maybe we don't necessarily need as much protection. Gold comes down, money flows into equity markets, as we saw a bit of a squeeze over the last little while in the US, right? Okay, bar the last 4 trading days, but over the last few weeks, sort of certainly since the beginning of January, the market has been very, very strong. But then you are just at the same time, you have the exact opposite happening in the oil market, where oil is sort of softening on the expectation that, well, hey, maybe global recession is going to happen, and maybe inflation is going to be more than anticipated, and maybe we're going to see a decrease in demand for energy because, well, the world economy is slowing down. So you've got these two direct opposing forces that are interacting with each other in different markets, and they're having different outcomes. In the gold space, people are feeling less optimistic for gold and more optimistic for equities, but in the energy space, people are feeling less optimistic for the global economy and therefore less optimistic for energy demand. So it's a very confusing time to be alive, let me put it that way. In general, I'll give you our view at the moment, which is energy prices continue to rise. Interest rates continue to rise. Equity markets are probably in for another maybe 4 to 6 months of difficult times before we start to see a bottom. So we still preach caution. And when the market is extremely confusing like this, having a healthy cash portion in your portfolio is not necessarily a bad thing. We are sitting with somewhere between 25 and 30% of cash in our client portfolios, and we're just being defensive, right? The time to re-enter the market and be bullish will come. Whether or not that is today, I don't know, because as we've just seen, we have two very, very different economic expectations playing out into very different instruments, right?
A confusing time to be alive, and how? Well, there's been less optimism on the part of consumers to refurbish their homes, as reflected in Italtal's weaker earnings.
Yeah, so Italtal put out a trading statement today. Let me just open it up here. It's actually not so bad. System-wide turnover is positive by 3%. So that's their entire ecosystem of all their brick-and-mortar stores and all their online stuff is actually up. But what is interesting is trading profits are down by some 8%. Headline earnings is down by 6%. Net cash position, they're being very, very good with protecting their balance sheet. Net cash position is up 51%. So what is encouraging here is to see that the company sees there is a difficult economic time. They do cite that, during 2020, when everyone was on lockdown, there was a massive boom for home improvements because, surprise, surprise, everybody was at home with nothing to do. So they started doing home improvements. Backwind has now left their sales. And we're sort of back to, there was a bit of a normalization period. And now what we're starting to see is that higher interest rates and lower economic activity is really starting to bite. And I'm going to bring electricity into this as well. Electricity makes it really, really, really hard for businesses to run. So businesses are under pressure, which means those business owners are under pressure. And all of this is sort of cascading into the general consumer just having less money, right? And therefore spending less money on home improvements and that type of thing. And during all of this, what they do is they shore up their cash balance by some 51%, which I think is a sign of good management. So, in the long term, it seems as though Italtal is on the right track. But in the short term, it does feel that as we expect at least economic conditions to continue to tighten over the next 6 or so months, it's going to continue to be a tough time for consumer-facing businesses such as Italtal that is so dependent on disposable income.
What about Anglo-American Platinum? They published their trading statement for the 12 months ending 31 December 2022. How did they fare?
Yeah, also not really good reading, right? I'm still sort of working my way through this, but from what I can see is that earnings per share is expected to be down by some 33 to 52%, similar with headline earnings per share. They cite lower sales that came off quite a bit. Sorry, they say despite an increase 2%, an increase of 2% in the rand price basket of platinum, they have a decrease of 26% in sales. So I haven't really dug into this too much as yet, but it's not great reading for Anglo-American Platinum at this stage.
Petri Redelinghuys, founder of Herenya Capital. Thank you.